Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. Best place to do that is to follow me on Twitter at @FocusCompound. If you're watching the screen right now, focuscompound.com is a place to get access to investment write-ups on different stocks and investing topics, going all the way back to 2005 by Geoff. You could see right now that the last blog post he had uploaded was on May 1st, how acquisitions add value or don't. And we have a few different stock write-ups as well. So if you want to get access to that for free, go to your browser, type in focuscompound.com, and you'll see it right there on your webpage. If you're interested in learning more about our money management services, yes, we do run a hedge fund. Yes, we do run a managed accounts firm. You can reach out to me at andrew@focuscompounding.com. All of that information is on that Invest With Us tab at our website, focuscompounding.com, for the third or fourth time that I've mentioned it in the past few minutes. So, Geoff, we could talk a little bit about the past blog post, most recent blog post you uploaded May 1st, 2023, how acquisitions add value or don't. Take us through this blog post. So somebody had sent you an email. How do you think management should analyze acquisition opportunities? And then you had sent in a response. So do you actually email these people back, or do you just tell them that you're going to make a blog post out of it?
No, it's always emailed back to them. Usually the blog post is some fraction of the email. So sometimes some things I remove from the email. But a lot of times it's close to 100% of what you see in the blog post is what I email them back. Yeah.
Mm-hmm. So you said the best acquisitions are often horizontal mergers where the company, for example, one rolling up smaller businesses in its same industry, acquires companies that have similar distribution channels, customers, suppliers, etc., and may increase market power this way. There are often cost synergies, especially economies of scale, and sharing fixed costs across acquired businesses in this sort of merger. So a merger might be done at a high price relative to the acquired company's previous EBITDA, earnings, etc., but at a reasonable price after these synergies are achieved. So that's always the pitch, right? Cost synergies, further market power, stuff like that. Interestingly, the individual that we're going to speak about today and the company we're going to speak about today, Warren Buffett, his acquisitions are a little bit different. Mm-hmm. So just what are your general thoughts on businesses that are rolling up industries, investment companies in general, or holding companies in general that are looking to buy part of or huge stakes or all of the business itself? What are your thoughts on that as a business model?
I don't usually like them. They get recognized pretty quickly by the market, and it's usually a limited amount that they can do of acquiring stuff before it doesn't work out. So there may be particular niches that people, there's not competition for acquisitions and stuff, but, funeral homes were rolled up, right? And so there was a time where you could do that, where you paid very low multiples and you were awarded a much higher multiple in the market, and then that goes away. So the ones that are really successful are things like Teledyne and Berkshire, and they know how to pivot so that they make certain kinds of acquisitions when those make sense, and then at other times they have to do completely different things. So, Teledyne issued a lot of stock to acquire a lot of tech companies early on, and then when its stock was cheap, it bought back its stock. Berkshire used to have a huge investment portfolio and not buy entire businesses. Then when stocks got expensive, it stopped, putting a lot into investments and put a lot more into buying businesses. So most companies don't do that. Whatever they do, they'll keep doing, endlessly. And so at some point, they'll run into problems of scale. You'll need bigger acquisitions to move the needle. You have to pay higher amounts, all of that. So a lot of it works out in the beginning and then doesn't work out as well later. And usually by the time you've discovered the idea and heard a lot of people talk about the compound record and everything, a lot of that's already happened. So ideally, you have someone who understands capital allocation, is pretty flexible, can pivot, but that's not usually how these companies work.
So Buffett and Munger bring up Teledyne pretty often, I would say.
Mm-hmm.
My view is that the general public does not. Why do you think that is?
Well, one, it's not any sort of name that they know, but Berkshire Hathaway wouldn't be a name they know other than Warren Buffett, you know. So the company was basically one person. It only lasted in a successful form for about 25 years before it was broken up. Also, buybacks at that time were not popular. In fact, it was criticized, though there was a defense written by some investor. I can't remember if it was Cooperman or someone like that, of that. But it was criticized specifically for doing the buybacks, that they don't have anything else to do that. Took passive positions in other stocks, which is always confusing to people, just like Berkshire's position in Occidental. Very large, right? But we're not going to acquire the whole company. He did that, and Henry Singleton, and no one believed him, but that's what he did, and he held on to those stocks. So I just think they're not, that was an era when that wasn't a focus. There is the book The Outsiders that talks about it, some others later, but the focus wasn't generally who has the best compound record. Buffett had been a money manager, so he came from a different situation and attracted different people who, sort of looked at Berkshire through that lens, right? But Teledyne, the idea of acquiring all the stuff, then not acquiring more, buying stuff back, slowing growth, breaking it up, for people in technology things, that may not be the kind of model that they look to.
Mm-hmm. Interesting. Well, today is May 11th, 2023. We flew to Omaha. This time last week, we were in Omaha for the Berkshire Hathaway meeting. Met up with a bunch of investors, a few prospective investors, and spent some time with people. Went to the Willow Oak event, and I wanted to dedicate this podcast to just our overall general thoughts on the meeting. So, did you have a good time in Omaha, Geoff?
Yes, it was much better this time than last time, much easier. We had done this before, so many of the things we already knew what was going to happen. I thought the Willow Oak event was improved from the year before, ran very smoothly. Mm-hmm. We had to leave immediately. So
I don't know what that means because I moderated the previous year. Oh, everyone's saying that this year was so much better. So what's that all about?
Yeah. So, yeah, I thought that was good. For people who don't know, Willow Oak is our partner in the administrative and marketing aspects of the investment arm of our business. They don't have anything to do with investing. And they do that for other funds too. And those were other fund managers were there at the event. And so they put on that event, So it's sort of like one of these, when you hear whatever manager in conversation with whoever, it was that kind of event, right?
Mm-hmm. Mm-hmm. No, I think the format was better this year. I mean, quite frankly, I would have much rather moderated this year than last year because, well, this year it was, I think each person had moderators had 45 minutes up there. So they broke it up more for those that weren't allowed to or did not make it to the meeting. They had a few different sessions. There was one with Geoff and Shri and Jacob McDonough, the author of Capital Allocation. And then it was an individual from In Practice up there with Keith and Stephen Keel. And then I, at the end, came up there with all of the managers and just basically opened up the room to questions. So I thought that was a much better format. There was a lot less downtime this year, I would say. Last year, there was an hour of mingling, I guess, before the event started. And then it was, 2 hours of the actual event. And then it basically closed. This year, it was doors opened up at 5 o'clock. The presentation started at 5:25. And then it was just 45-minute increments of different things. So I think the overall format of it made for a much better, conference or meeting, whatever you want to call it. And it was great. I think people really enjoyed it. A lot of people have basically said the same thing. Just it kept the this pace was much better this year, I would say. So it was a lot of fun. I enjoyed it. It went by a lot quicker than it did last year. I think just because they had these two or a few different micro sessions. So I think it was a great format. And it is awesome to meet a lot of people as well.
Yeah. And the moderator that we're talking about, the interviewer for one of the sessions, which I was part of, was Jacob McDonough, who wrote Capital Allocation. That book was on sale there in Berkshire. Apparently, he did quite well selling it. We also saw it at the airport selling nicely. So that is a book that I would recommend to anyone who hasn't read it yet. If you've been a long-time listener to the podcast, you probably heard us cover Berkshire history a little bit, and we talked about that with that book. So that's when we talked about it in the past. But that was a very good choice, right? As a moderator, very good choice of someone who knew a lot about value investing, about Berkshire. A great choice for someone to have do that. A lot of times you have more general, less interesting interviewers for any event that you do. And this one was someone who really knew the stuff and knew that niche.
Yeah, absolutely. So, like I said, got to meet a lot of people that listen to the podcast. Always surprised by how many people listen that are outside the United States. Pretty cool, just from the perspective of the reach that the podcast has. So that aspect was awesome. What did you think about the annual, the AGM, the actual Berkshire meeting itself?
I thought it was good. It was better paced and answering a lot more questions and everything than the last few years since COVID, where Buffett hosted alone and everything. It's been off. They've been off their game that way. So it was helpful that way. Not a lot of rambling and all of that. There is a lot of ESG, political, more general, whatever sorts of things. And that's been true for a long time. There's some interesting stories they tell and all of that, but mostly it's despite the questions, not really because of the questions being all that good usually. So there were a few things I thought were really interesting that they said, but it was prompted sometimes by questions, but almost they did that on their own. You know,
a lot more kids asking questions than I remember. A lot more questions on estate planning, philanthropy, ESG, as you had said. Kind of gone are the days, it seems like, if you go back on the Buffett archive and listen to like the 90s of actually talking about like, you know, a ton of business stuff and return on invested capital and how they think about things and stuff like that.
Right. I mean, they brought out, Buffett had little signs that, you know, to flip around that would say available for sale and held to maturity, right? So he's prepared for that. That was a nice stunt for that. But to give an idea on that about the banking thing, I would guess if we went through a transcript, there was more talk about climate change than about the banking crisis.
Well, they didn't bring it out to the second half. So he had that sitting there the whole time, probably expecting people to ask about it.
Right.
And, you know, that was going to be his prop, but nobody asked about it. So, yeah, you're right. Yeah, 100%. Yeah.
Now, Berkshire is a giant energy company, Berkshire Hathaway Energy, big in renewables, regulated, but big in that stuff in the United States. And Berkshire does own Chevron and Occidental in big amounts. But it also, Bank of America is one of its very biggest positions, you know, excluding something like Apple or something. It's a huge position. And Buffett's been a long time investor in banks. The company owned a bank and disposed of it just because of the bank holding company stuff where they want to be allowed to own both insurance and banking. And he talked a little bit about that, which was interesting because that relates to Jacob's book, you know, Capital Allocation. That history of Berkshire is like one thing he explores there is what if Buffett had a different vehicle, right? What if like Buffett had been able to take over American Express or been able to use float from some other source or whatever instead of building on this textile mill? And you can see how flexible Buffett was in that. He said, yeah, I mean, we might have done both insurance and banking. At the time, we were more likely to do more banking than insurance. It looked like a better business. It was definitely a better business for a little while there. Because although Berkshire did well with insurance in terms of investing that float, and there were great investment opportunities, their operating results in insurance were mixed outside of their some initial acquisition. Any expansion they tried to do was not good for a long time in that. So it's interesting because you think of him as having this like grand scheme of the whole insurance thing and stuff, and they would have, you know, they bought National Indemnity and they bought the Rockford Bank. And, he's like, we could have done both, or we could have been much bigger in banking than ever we would have been in insurance. So it definitely would have been nice to hear a lot of questions asked about him about banking. And he seemed very eager to volunteer his ideas. He was very critical of the media coverage and the government response. So that was interesting.
Yeah, he said the messaging has been very poor. It's been poor by politicians. It's been poor by the agencies. And it's been poor by the press. And he reiterated that, as you did, actually, when everything was happening, that there are no risk to any deposits in the United States. And Buffett had brought that up. Now, he did give praise to the FDIC for stepping in when they did for Silicon Valley Bank, basically saying that it would have been catastrophic if they did not. But yeah, he criticized just like, I guess, the narrative around it and the lack of communication to everyday people, basically, on what's going on in banking. Basically saying that all of the deposits are safe and you don't need to worry from that aspect.
Right,
I think Munger said bad bankers. Yeah, the uninsured. And I think Munger said that bad bankers should be punished, or maybe that was Buffett, but, kind of something that they have probably always thought. I mean, Munger was basically saying he liked the banking business a lot more when there wasn't an investment banking division, and then all the greed and everything that basically comes with that.
Yeah. And Buffett was also critical, saying, especially politicians, I think, but also maybe media, he meant it for too, that, some of them don't know what they're talking about. And so that's why they do a bad job of communicating, but others know better and for their own purposes are not clear about it. Right. So they're okay with letting people be scared if it helps them in terms of winning points politically, or maybe their ideas for reform or whatever, or benefit from that, or their side from whatever, making it look like other people are to blame for stuff. It's kind of, they benefit from there being some crisis, right? Instead of saying everything's fine, don't worry about it. Yeah. And like you said about Munger, the Berkshire has been in pretty big banks and stuff for a while now, later on in the years. And so it's much more exposed to those kinds of things. Obviously, it was a big investor in Solomon, though it really just wanted the preferred and didn't want to be involved in that business. But Munger ended up having to be on that board and everything. Bank of America is big in that stuff because that's the only thing they can do in size. They've sold most of their other bank stuff anyway. But it's a long, long time since they've been in much more traditional forms of banking.
And he said, we don't know where the shareholders of big banks or the regional banks or any bank are heading, but he's not bailing on Bank of America. And we've seen that in their 13Fs he still owns Bank of America in size.
He said something very, very interesting about that one. He made a point of saying that he had solicited them and not the other way around, which sounds like if it had been a stock they bought in the public markets, they would have sold it. And maybe even if Bank of America said, here, we need your help, they would have sold it now. But because he said, I would like to do this, and they did it, it doesn't feel like he can, sell out on them, that he's stuck in it. Bank of America has some of the issues that were shown on those little signs, right? The held to maturity thing. So, it's too big to fail bank, but as Buffett said, he's not really concerned about the deposits at banks. So, I think it's probably not the case that he's kept Bank of America and not the other banks because he likes Bank of America a lot more. I don't know that there's like dramatically different stuff with Bank of America versus U.S. Bank or something, which I believe he sold.
What did you think about his comments politically? So he did bring up politicians, and he hit on politics a little bit today, where he's basically saying today it's all about like tribalism. Like it seems like there's no like middle ground or being able to like debate on things or diplomacy. He's like, it's just one way basically thinks one way and the other way basically thinks the other way. And it doesn't seem like people want to be diplomatic and try to work out issues. He just kind of sounded like he was basically saying politics today makes people's brain turn to cabbage, which I was kind of surprised to hear him talk about politics a little bit.
I think he tries not to talk about politics with Berkshire since about whatever it was 10 years ago or something, when they talked about the Buffett tax and the Buffett rule for the taxes and things, and he had some general points. He's done it a few times, but in his career, he's been involved with some political things with nuclear, working with specific people to try to reduce risk of nuclear war. He certainly worked on things, writing up stuff about the trade deficit and about just fiscal deficit. And then he had been involved with income inequality stuff, specifically with the idea of people who make a lot of money not having especially low taxes, right? Because it's all from investment things and stuff like that. Unfortunately, that became very associated positively by one side and not so much by the other and stuff. And so I think it made him, like he was saying with the tribalism, much more a favorite of one group and not of the other, when I don't even know that many of his positions would be particularly well liked by the party on the other things. It's just that because he was in favor of that, talking about, how he pays a lower tax rate than a secretary and all that stuff, that became such a talking point that I think that was that from that point on, I think it was a little scary for him in terms of how associated that was with Berkshire, how it could hurt Berkshire in ways and stuff. And so I think he's tried to, as best he can, not talk about politics. Even though he's always been involved in politics. I mean, his dad was a congressman, and even though he was switched parties, Buffett, not his dad, he's been continuously involved behind the scenes and stuff and supporting certain people that he likes and whatever. But public statements that could be make headlines and be associated with Berkshire, he's definitely toned those down in the last decade, I think.
So we were talking about it. He talked about Occidental at the meeting. Something that I thought was interesting was he basically he confirmed that they won't be making an offer for Occidental, which I was kind of surprised to hear him talk publicly about something that they're probably buying. Maybe they're not buying it now, but he did say, we will not be making an offer for Occidental, but we love the shares we have. We may or may not own more in the future, but we certainly have warrants on a very substantial amount of stock at around $59 a share. Those warrants last a long time, and I'm glad we have them. So
I think it's possible that they've decided they will not outright own an oil company. And that's what that statement really means. I think there's some things Berkshire will not own. Probably for, the airlines are a good example, right? So they were large owners, but not controlling in any airline. If they'd owned one airline, it would have been okay, because then Berkshire could have handled that and they wouldn't have needed a bailout and everything. But Berkshire can't bail out all of the airlines. And yet, as Buffett said, they're not going to give a bailout. It's not going to look good for the government to bail out airlines where the largest shareholder is Berkshire Hathaway. So I think there's some stuff that they might avoid. And I would guess they don't want to control an oil company, probably. But we'll see. There's just some stuff that I think they will not do, and I think that's probably one of them. And because they have an insurance business, they're pretty big. They have some politically sensitive things, the energy company and the railroad. I think insurance needing the great credit rating for that and being in that, and then two things that are federally subject to a lot of regulation and stuff with energy and the railroad. I think they may not want to own an oil company outright. I wouldn't be surprised if that's the case.
He had said that in the last few months, Occidental had reduced their preferred. He said, which we don't like, but we'd be disappointed in them if they didn't reduce it. It's intelligent from their standpoint. Of the 10 billion preferred, we've got maybe 400 to 500 million retired at 110% of par.
Yeah, that's the problem with preferred stock. It's usually able to be retired, called at rates that at percentage premiums that are not very large, and even just not even having to be a big improvement in the company's results, but just a change in interest rates may make it so you don't benefit a lot from it, right? So that's very often a problem as opposed to like common stock. There's a lot less upside. I think people
Would you be
overrate
interested?
all his preferred stock investments for that reason, like there's much more upside in the common stock if the business is desirable.
Do you think Occidental is desirable at these levels? I have it pulled up on the screen on QuickFS. EV to sales 1.9 times, 10-year median margins on EBIT 16.1, EV to free cash flow 5.6.
Buffett talked about this. We own a little energy, and we've never owned energy like oil and gas and stuff, and we've never owned that before. Also, we own some coal. So
Very ESG, Geoff.
very ESG, yeah. And also like the dirtiest coal and the
Done some things in gambling.
tightest oil, and yeah. So they talked a little about this in an interesting way. And I had mentioned that I'd read a book, The Prize, right? I read some other books too, but The Prize is the one that I thought was the best for people to read about the history of oil, just in a very general sense, and something that people might be interested in if they just like history and things like that, that it gives you enough about oil to sort of understand it from an economic perspective and all of that, and to understand without having to get into any predictions really about the future in that book, or about needing to know the geopolitics of today or whatever. It's quite a long book, and it's very good, and I would recommend that to people. The thing that they said, which is very interesting, is that the time structure of the assets, the life of the assets has changed a lot. Especially the marginal assets, which are the important ones for determining the price and everything, right? It doesn't much matter if 40% of oil is long-lived stuff in the Middle East or whatever. It would have little effect on the price because oil demand isn't going to drop by 60%. So the stuff that's going to come in and out of the market is going to be the more marginal stuff, and that has a much shorter life than it used to. And I think that's significant to think about. What that means for oil prices, what it means for decisions by these companies. So on the one hand...
Why does it have a shorter life than it used to?
The wells don't last as long. So you drill a well and you're going to have a very steep decline in the production. Yeah, very steep. So
I think they mentioned that in the thing.
Yeah, they talked about that. And so, for instance, where I was saying that we own some oil and gas and all that, it's stuff that's very, very steep decline, super steep. So it has a very, very short life, which has pluses and minuses. On the minus side, it really caps how much you can make by being aggressive in the business in picking the right spot to in time and price to make an investment that's going to pay off for a very long period of time, just like in a stock that way. So there's buying a junk bond might be great, but it's never going to replace buying Activision or something. And that's because Activision has, now it's trying to sell itself, but had, 25 years ago, infinite duration, basically. It was perpetual and had a lot of upside. Now, if you get something where you have, as they were talking about with Charlie, you have royalties on something where you have it at some very cheap price, that's fine, but it's not going to produce anything 6 years from now. So it's not something that's going to be producing 60 years from now. And so that's very different. It also means that if you don't spend on CapEx, then pretty quickly you'll reduce the supply that you have. And so that adjustment can be made faster. So that's very important. And that leads to a more rational industry, usually when that happens. The least rational industries, the ones that have the most boom and bust issues, are ones that have assets with very long lives. The shorter the life of the asset, the easier it is to manage the business. So I think that's interesting. There are downsides to it, though. Like, for instance, you won't benefit as much from inflation. It's not as good an inflation hedge if it's shorter term like that, since owning a real asset longer term without having to put more money in is much better, right? So holding a royalty on a well that's going to produce for half a century is a great hedge against inflation. having something where you have to work an interest, and putting a lot of capex and stuff into it, in future dollars in those years where you'll have to do this, is going to be a problem, right? You have to refract something, whatever you're spending in those 2026 dollars. If you're doing it, if you drilled in 2023 or whatever, you're going to have to work on it again in a few years, spend in those dollars, which at the rate of inflation today, that could be, 10-15% more expensive than today's dollars are in those. So obviously it would be better if you had mineral rights or royalties or whatever that you, that had production that would last for a long time. But that's not certainly in the United States, the new stuff that is coming online is nothing like that. Right. So that's a big change from some of the past.
Yeah, he had said that his $1,000, he paid $1,000 for a royalty that pays him $70,000 a year still, and he bought it in 1959 or something like that.
Yeah, read the prize. So you'll see the different places where they find oil and how it's different in each case. So you have Pennsylvania. This is just the U.S. ones. There's also ones over in what would it be? Modern day, I don't know. It would be Azerbaijan. That area of the what was the Soviet Union and stuff. There's things there where they find oil. But where they find it in Texas, of course, was a big deal in the United States, and there's talk about that because the prize discusses how that was kind of the precursor to OPEC, was the United States' attempts to control oil prices because of how cheap it was getting because of a huge find in Texas. And so the state of Texas had a system in place, which basically is the model for what OPEC is, the idea that you could have a cartel and that you could do that. But of course, at the time, that Texas oil, and then later OPEC, when it was doing this, was much more important to the market than it is now. Those things aren't as important. There's a lot of supply they can't control.
So do you think he'll continue to buy Occidental stock then? I mean, I remember seeing his 13Fs. Every time it would come through, it was just continue to climb, and people were speculating, oh, is he going to take control of this company? Is it, what's he doing? So he basically spiked all of those questions. So do you expect him to continue buying Occidental?
I don't know. He's kind of limited. I mean, he owns already a huge amount. He doesn't want to take control. The problem is he bought PetroChina one time, but it's really, really, really hard to invest in oil as a individual like Buffett or like me or whatever, looking at investing in things. Even if you like oil, you have pretty serious problems in terms of where is it, who controls it, what's their capex going to be. And so you don't have a way to do what they'd like to do, which is to buy reserves and then to hold them if he's worried about things like inflation, or he thinks that the price is reasonable versus what he's likely to see in the future. So you'll remember he bought silver on that basis at one time, had to buy up a fifth of the world's supply of silver or something, and getting in and getting out moves the price, and so just to do it in scale. So I'm sure if he liked Exxon, he would buy a lot of Exxon. If he liked whatever else, he'd buy a lot of that. He probably doesn't like Chevron as much as he likes Occidental, but he can get more Chevron, and we've have that experience when we invest in things that are not very liquid for us. These are things that aren't very liquid for him. He has to buy such huge parts of the company that even if you don't like Chevron as much as you like Occidental, which I'm pretty sure he doesn't, he can get a lot of it, so he can put a lot of money to work. If he wants to be in the United States, if he wants to be with management that's doing certain things, your options are limited. They're really limited. And so there are some, and then they trade at different prices and stuff versus reserves, their likely value of the reserves, right? So he's willing, obviously, to buy certain kinds of things. They asked questions about the Permian and stuff in the annual meeting, and he's fine with that. But I don't think he's fine with any sort of capital allocation, that it doesn't matter. I don't think... So it depends on the balance sheet of the company and what their capital allocation is going to go to. There's a bunch of oil companies that are pretty cheap in the United States, much smaller. We're talking about, what's the market cap on Occidental?
51 billion.
Okay. So let's say 10 to 20 times smaller, more like 20 times smaller probably. And they're in places that I could understand and whatever. But see, 10 years ago or whatever, they may have had a lot of debt. and they didn't go bankrupt, or they didn't get rid of all their debt in bankruptcy or whatever. So they're going to basically delever, which is terrible, right? So I mean, they're taking a real resource out of the ground. Sometimes it's their choice because they're the operator and stuff. Sometimes it's not really, but regardless, they're taking out a resource which is likely to be worth more money in nominal dollars in the future, and they're using it to pay off debt at basically face value of the debt, which is way inflated over the value of what the debt should be today, right? So they're paying like almost probably $2 to retire debt that in the market, in terms of opportunity costs and stuff, might be worth $1 or something. And they're doing it by taking out a finite resource out of the ground to do that. It's just terrible, So like to sell oil to pay off long-term debt at 5% or something is insane, but they want to do it. So because all these companies had near-death experiences 10 years ago. So they've all, found religion on that stuff, and so are making capital allocation decisions that aren't that great. So it really depends on what your history was. Like if you're able to buy back stock and everything, and those all say, oh, we'll buy back stock once we get our debt down to a certain level, but they're not doing what they should, which is to leave the debt and buy back the stock. It's a big issue. And when they're done paying off the debt, the price might be really high versus the reserves, and then you don't want them to buy back the stock, You want them to buy back the stock when it's cheaper than going out and acquiring or developing additional reserves, to buy back, say, your reserves per share are better. So I think that he's just limited with that, right? So he's not going to buy these companies that are all over the world in different places where he doesn't understand them and where he doesn't understand the capital allocation. So I think his heavy buying in a couple companies, probably he likes those companies a lot, and Berkshire has so much capital to deploy that's why he can't spread it out across the whole industry. He was very clear that it's mainly tied to the price of oil. The future price of oil is what determines your returns in these investments, and that's what this is a bet on. It is a bet on the future price of oil, but he doesn't want something to come along and screw up that bet. And there's too many companies where there's something that could screw it up in terms of capital allocation. So, I mean, you don't know that some giant oil company won't do a transformative acquisition of some, much more ESG friendly new energy thing or whatever. You just don't know. And there's probably some weird risks for that around the world in the biggest energy companies.
I mean, do you think he's thinking about this from an ownership perspective to hold over the next like 10, 15, 20, 30 years?
Yeah. Oh, yeah, sure. I think he would love to own oil in the United States if the company promised not to engage in any additional capital allocation towards it. That is, if they used what they have and turned it into cash and paid it out. Yeah. So if it was very economical to increase production in some ways on some of the properties, the acreage that they already have and everything. Maybe if they could combine it with some things really close by and stuff, even that wouldn't bother him. But doing anything outside of the areas that they're already in, and not running it like a trust that's going to pay out to you and stuff is the issue. It's not a bad business, but it has very serious issues in terms of capital allocation. And often the stocks don't turn out to be that good compared to what they should be, given what the properties were at the time you bought it and the price you got. So, and yeah, I think he'd like to be in oil, not natural gas. And I think he'd like to be in the United States, not anywhere else. So that limits your choices, especially when you're such a huge company that you need to buy like tens of billions of dollars.
So he talked a little bit about U.S. and China tensions, his selling of Taiwan Semiconductor. He praised them, right? Said that management's done a great job there, and he talked pretty highly about the company, but he did sell the business. And my takeaway from that was he just is very uncomfortable with the tension between China, Taiwan, and the United States. He said, I feel better about capital we've got deployed in Japan than Taiwan. Right. I wish it weren't so, but that's the reality. And then Munger said everything that increases tension between the U.S. and China is stupid, stupid, stupid. And then he said that they should both respond to the other stupidity with reciprocal kindness. The other side's stupidity with reciprocal kindness. So he kind of made a joke about that. But my biggest takeaway, he praised Taiwan Semiconductor, talked about how good management is, but he did sell the stock, so he's just very uncomfortable with everything that's going on geopolitically.
Taiwan Semiconductors is zero if you can't get out of Taiwan, right? So in the event of an invasion of Taiwan by the People's Republic of China, an American investor would not be able to get money out. We don't know that there'd be any value to Taiwan Semiconductor stock at all. Obviously, there's risk that there's no value to anything in China if you're on the wrong side of China in a conflict. But certainly, Taiwan is specifically in Taiwan. Would be the site of that, and they would have problems because of that. So, and it's not an unrealistic worry. There's many companies that have become zeros for investors in other countries because of war, and it doesn't have any diversification away from that risk. So when Russia invaded Ukraine, even companies that people said, oh, they're very exposed to Russia and everything, it's 2% of their business or something, that they would lose. That would be a zero. Here we're talking about something that it's 100% of your business, So, yeah. And so it doesn't have to be in a particularly high risk, but it changes the calculation completely. And we've talked about that before, even if you think
the catastrophic risk.
Mm-hmm. Yeah. I mean, even if you think that there's a 50-50 chance that there'll be an invasion of Taiwan by China within 15 years, that would be enough to basically change the stock from a buy to a sell for most investors looking at sort of their opportunity costs and stuff, unless the price was very different, because the percentage chance per year then is quite high. And that's just the reality of what the risk is. And obviously tensions between the United States and China are high, especially, and a lot worse than they were before. And we talked about that with the, it's probably a reaction to changes in the, not so much what they were asking about with Munger about actual tension between the United States and China, but changes in the priorities of the Chinese government. Right. So there may be greater priorities on security, and lower priorities on economic growth and stuff. And so that's the trade-off in any invasion of Taiwan, is that if you're focused on improving your position globally, your prestige, nationalism, all of those things, it's a more attractive gamble to make if you're willing to take big risks on the economic side, because that's where you're going to suffer in exchange for gains on the other side. So, so if a Chinese government is more interested in certain geopolitical considerations that are not economic, then it greatly increases the chance that they would do something like that. What would stop them from doing it is basically understanding how high the risks are economically.
Yeah. Well, that was interesting to hear him talk about that. I think that was my biggest takeaway. We've talked off podcast about this, how good he is, where he doesn't care if people know that he purchases a company or buys a stock or whatever. And if he decides, oh, wow, this is a little bit different than I thought it was, or he changes his mind on something, he's so quick just to get out and dump it and move on to the next thing. Some people would probably sit and wait, be like, oh, let's see what happens, and kind of convince themselves or be in denial about it or whatever. And, perhaps he's even in denial about it, but the fact that he's uncomfortable with it, that's his view of the situation. He bought it and he dumped it, I think just shows how skillful he is. Because I think the question that somebody asked him was basically, hey, not much changed with the situation between the time that you bought it and you sold it. So what changed?
Yeah. Well, a lot changed. So it's, I think in part, that's what makes him good in being in the insurance business, right? So, I mean, I think that it's not unreasonable to think that no one insures these risks, but insuring that kind of risk would have gone up a lot versus what the situation was a little bit earlier. It may not seem that a lot has changed, but sometimes your weighting of the probabilities changes a great deal. And we've talked about that here, especially with like interest rate risk. It's always present, and we're well aware of it. And you can look at the banks and say this is how much they would suffer if rates go up 200 basis points instantaneously or down. But how realistic is the possibility that that would happen? A few years ago, it's a risk, but you assign a very low probability to that kind of catastrophe hitting a bank. But you start to have that number go up a lot pretty long ago when you see, as we talked about in this podcast, what we said, a rule of thumb would say you take rates to 6 to 10% if you need to bring inflation down to 2%, like immediately. Now,
we said that back in January, early 2022.
Right. Yeah, rule of thumb, but they're not going to do it. But now you're starting to think, well, it's shifted dramatically. You've gone from something in which you're talking about those, you're a couple standard deviations out in terms of the kinds of events that you're expecting now. So at first, in any given year, you're thinking, okay, there's a very small range of what's likely, right? But although the frequency is quite low, the severity increases a great deal when this happens. So now you're looking at this is a once in every 50 years type event, and then getting realistic about that. And of course, the one that, I always say is, when people show in a presentation for insurance things, this is what it would be if we had the worst event ever, and I always say last time it was the worst event ever, it was worse than the worst event before. Otherwise it wouldn't be the worst event, So there'll always be a new record that you can set in those things. And that's what happened this time. They would say, oh, well, if they raised it the way they did in the 70s, oh, well, they raised it faster this time, right? So even if you had planned for rates to rise as fast as that. And and I think that also relates a lot to the Russian invasion of Ukraine. That was similar to the interest rate issue in that there was a great deal of denial from people. There was sufficient information to understand that we were at high risk of rates having to be raised quickly, even though the Fed insisted that, no, we're not going to do that right now. And no one was penciling those things in. People were very slow to put in those, to make assumptions about rate increases if you look at analysts and stuff. And people were very unrealistic about the risk that Russia was going to invade Ukraine, because it was almost certain from the evidence that was available. And yet, just because it had not happened for such a long time, there was denial about it the same way as with the rate increases. So this is nothing as immediate as that, but there are real changes in terms of at least how they're trying. It's certainly, if there aren't real changes in the Chinese government's actual views about things, there's clearly a change in how they want to be perceived by others. So they may be bluffing about those things, but they're certainly trying to communicate publicly to the United States and stuff a different posture than it was the case in the past. You can see that just with speeches and stuff. The change is complete. Anything that they have to understand is for international consumption, that people are reading these things, has shifted dramatically in terms of how little is said about economic things and how much is said about security things, which is, code for possible expansion, for defense against expansion by others, all that kind of stuff. So it's changed a lot. Yeah. On the other hand, it like we've said before, obviously the response to the Russian invasion of Ukraine does decrease the chance of of that kind of thing happening in Taiwan, obviously, because no one would have expected the response to be as strong against Russia as it has been. So the cost just seems higher to anyone thinking about invading a neighbor.
And he talked about how comfortable he is, or more comfortable he is, investing in Japan. And he did go to Japan. I don't know if we talked about it on the podcast, but I know we definitely watched the interview when he was in Japan, and Becky Quick flew there for that, and met with, I don't know what they say, like 5 companies, 6 companies, something like that. We were looking at the Japanese investor handbook and saw one of the companies I believe that he owned, correct? And all of them look pretty cheap, right? I mean, a lot of companies look cheap in Japan. Actually, I was going to look at, I was going to send to you, I found this presentation that I queued up for later. I haven't looked at it yet, but basically talking about how, I don't know if governance is the right word, but how Japan is trying to make their markets a little bit more investor friendly. So they're starting to educate a lot of these public companies in Japan about capital allocation, dividends, buybacks, to make it more investor friendly to the rest of the world. So what are your thoughts on that?
A few thoughts. So Japan Company Handbook is the name of what we're looking at. It has about 2,500 stocks, I think, in the issue we're looking at. It comes out quarterly. You can get it if you have an Amazon Japan account. There are other ways to get it too, but that's the easiest way to get it. So we're looking at that in the airport in Omaha, yeah. And it organizes. So if you haven't been in Japanese markets or something before, unlike the United States, Japan, like some other Asian markets, uses a numbering system. So you know the number of the company, right? So you know it's like 4878 or something instead of knowing a ticker in terms of letters. What's nice about that is they organize the companies on the codes, the number codes, by what industries they're in and things like that. And so you move throughout the book very easily that way. And so the trading companies are all organized together. And so you can see everything that it's very easy to see all the companies that Buffett owns stock in. And he's done well in them. Some have gone up more than others, but they were all cheap then, and they're still, compared to big giant companies, pretty cheap in Japan now versus other places, things he invests in specifically. Not everything in Japan is cheap, but those are, compared to peers, what he got into. As far as the governance thing, I mean, it's beyond educating. It's really shaming them. It's, trying to say, you're doing a bad job if your return on equity is below a certain thing. You have to do these things. You should be doing them, and changing the ideas about what is proper behavior and what isn't. I think that's really what you're seeing. Trying to say, like, it's now proper behavior to think about having higher returns for your shareholders and stuff. And so whether it's government, the exchanges, all that stuff that you're talking about, it's basically saying here are the poor performing ones and what they should do to improve it. And yeah, I would say it's a shift in sort of moral priorities and stuff is the idea behind it.
Do you think shaming is the best way to
Yes.
get what they want out of that? Yeah.
Yeah, 100%. Yeah. In Japan. I don't know if it works as well in the
yeah.
United States, but in Japan, yeah. Mm-hmm.
Uh-huh.
Yeah. Well, for a few reasons. One, they want everyone to do it. So the educating idea, it's nice, but educating, you only get part of the people to do it, right?
Sure.
If you educate people, it's like the ESG things we're talking about. You can educate people about ESG all the time, but maybe only a small number who care about that stuff will take it up. If you shame them and make them show their boards all white males and stuff, then that can force them to take some steps so that they're not way out of step in the worst of anything. So, in the United States, this is usually how they do ESG type things and stuff is shaming. So, I mean, I also think shaming works better on organizations and stuff that way, usually. Then it's easier to do than in individuals, right? So like it's easier to get an overall group to move along on something if you do that, because usually they're not as committed as an individual will be to having a strong opinion on something. Most boards are kind of wishy-washy on everything, and if you make it so that it's embarrassing in one way or the other, then they'll go in that direction that you want them to. So an individual is a little bit harder sometimes because they may actually have strong opinions on something, right? I don't think you can shame Buffett out of some investment or something. He's very set in his investment things. He held PetroChina even when they, tried that. So, but as long as they don't have strong opinions, right, about some of those things, and I think that they can implement changes, sure. But there's other things that I don't know. There's certain companies that I think it's easier than others. I think there's a misconception that more Japanese companies are bad businesses than they are. As long as the business is inherently a pretty good business, it's an industry, product economics, whatever, that's good in other countries, I found that the returns on equity and stuff aren't bad. The problems are particularly that they have in places where the business isn't very good and they won't stop investing in it, But if you happen to have a more focused company that's focused on categories that are inherently not bad, then it doesn't matter as much. The capital allocation is generally poor in Japan, but they don't run the businesses any less efficiently, So, I mean, Google, their capital allocation could be lousy. I don't know. Who knows? A stock exchange, we don't know what their capital allocation is. Moody's, it's just a great business. It has, in tremendous margins and stuff. So it looks great because the returns on equity are wonderful and everything. But a business that actually requires making decisions about where to put the money and where not to put the money, no, that's not very good in Japan generally. You don't want to do that because that's not their focus. They're not thinking generally about what's the cash return on this and how quickly do I get paid back and any of that stuff. They're thinking about whether it expands the business and does the right things for their customers and their employees and things like that.
Are you hopeful that it will change over time?
Well, I mean, I think it will change over time, yeah. There's a lot of issues, one, there's a lot of things by foreigners trying to get Japan to change, which I think is pointless, So, the activism by foreign activists and stuff, I don't, I mean, I'm not big on activism, even in countries in which you are in which is your home country and everything. But certainly going to other places from being in another country, you're not going to get anything accomplished there. They're not going to listen to you, right? So I think, throughout much of the 2000s, there was just unrealistic expectations of what things would happen in Japan with Japanese companies and everything. But there's a lot of unrealistic expectations here too. I mean, people hate when they buy into cheap stocks and they don't do the things you want them to do. Mm-hmm. We see that a lot. People get very frustrated in the United States in microcaps that don't do what you want to do. You buy them at a fraction of book and everything. And so it's not a surprise to me that happens in Japan. Most American investors I've talked to, even if they have very high returns, get fed up investing in Japan and stop doing it.
Fed up just because it's status quo going forward. The stock price doesn't re-rate like they would hope is if capital allocation changed, or if they did a capital allocation thing like do a reverse capitalization or divvy out money or bring in more Western approaches to it. I mean, why do you think most people just kind of stop investing in Japan from your experience then? Not patient enough?
I don't know. I mean, I think it's the same reason they don't invest in value stocks and stay in value stocks, really. Like I said, I think they stop investing even in cases in which they get higher returns from Japan than they do from the United States. I think it's more fun to get okay returns in Google than great returns in Japan. It's just a psychological thing. I don't know. I mean, not for Warren Buffett, not for Walter Schloss, Ben Graham, but for most human beings, it is. Yeah.
Interesting. So about Activision, Buffett had said that he doesn't know how it will turn out, but if it doesn't go through, he doesn't think it's any shortcoming by Microsoft or Activision, and that not everything that should happen does happen. And he said that I think the British government is making a mistake in this case, but that's life in the big city, as Charlie would say. So interesting, because we've talked a lot about the merger arb situations that you would be interested in, and the best ones are the ones where
not one of them. Yeah.
The best ones are ones where you would want to own the stock or you like the valuation, the price, where if it doesn't go through, then you would be happy owning the company. So do you have any thoughts on Activision, Buffett's thoughts towards it, what he'll do with the stock if it doesn't go through?
This was always a questionable deal. On the one hand, you had a very eager coupling of the two companies, right? Because Activision has a problem because of things related to cultural, sexual harassment, all sorts of things. And then they are a basically founder-led company and stuff, right? So they don't have a professionalized organization that would be easy to leave to someone else and expect the same sort of results as they had before and everything. So basically, you've got to find a home for the company if you're throwing out the top people. So because of that, they were in a situation where they're basically for sale, right? Microsoft very much wants to buy a company like Activision. However, that doesn't mean that the deal will get done, and it didn't get done, or it doesn't look like it's going to get done. There can be objections to it and stuff, but mainly because people don't like Microsoft, So, and not that they love Activision either, but that's the reason. And governments can block anything that they want to block. In different countries, they have different rules and everything, but you always have to understand that You're at the mercy of those things with any of these deals. So whatever the rules say that they are, if I mean, we saw a bank merger that was called off, but it's basically because they're just not moving ahead on that. The government just kind of isn't working to merge healthy banks together. There's the takeovers that we've seen, but other than those emergency takeover things, it's basically just government policy. Don't want to see banks, merging together. Basically, it's not official policy, but it certainly seems to be at the pace they're working that's the policy. And there's all sorts of different countries where there's different things that they worry about, and it helps to not be disliked, to not be so big that you get noticed. So obviously, high-profile deals are always riskier. I think any FANG type thing that wants to buy something, the deal could be blocked in all sorts of different countries, regardless of what the deal is and all that. And that's the price of, raising your profile that much. That's why some companies try to be very quiet. Then you won't draw negative attention to yourself. Activision, the issues are it's a fancy price that Microsoft is paying, and it could drop a lot if it's not merged with them. So there's just it wasn't a sure thing. And then you have some potential for you didn't have much potential for a higher bid. You had realistic potential. It could be blocked. And then you didn't, and then you had a meaningful possibility of, the severity that you would have in the case that it did decline, that the deal didn't happen. So no, I don't like it as much as Spirit or something like we talked about. I don't even like it as much as Albertsons, and that's one that everyone will want to block. But it's better in terms of price and stuff. I mean, Activision's back about where they were originally buying the stock, right? Someone at Berkshire, not Buffett, was buying it before, because there was a scandal at the company which caused the stock to drop and stuff, as I was saying. And someone was buying it before the deal was announced. They didn't have any knowledge that the deal was going to be announced. And so that kind of probably gave some comfort to Buffett to buy it. Because you have the upside if the deal closes, and yet and he knew Microsoft was very serious about closing the deal, as is Activision, I think. But that, you're kind of back in the same place.
So they brought up Apple.
Okay.
Somebody had asked a question because Aswath Damodaran, he had talked about he gets pretty uncomfortable if a single position in his portfolio gets to be too big. And he had mentioned that Berkshire is 45.9%. I'm sorry, that Apple is 45.9% of Buffett's public portfolio. And it was funny. So the question basically was, is Apple too big for your portfolio or too much of the portfolio? And then Munger jumped in really quickly and said, I think he's out of his mind about Aswath. And then Buffett talked about how, he doesn't view that position as it's X percentage of the portfolio. He thinks about it as just a collection of every other business that they've purchased, like railroads and utilities, See's Candies, and everything like that. So they're just all businesses to him. He talked a little bit about it, Apple as a business in general. He said we put a fair amount of money in it, but we haven't got more money in it than we've got in railroads. Our railroad is a very good business, but it's not remotely as good as Apple's business. We don't have anything like Apple, but we're very, very happy to have 5.8%. And we're delighted with every 0.1% that goes up from them, buying back their stock. So very happy with their investment in Apple. But more importantly, my takeaway was just how he thinks about the position in general. It's just another investment. And he thinks about this conglomerate entirely, not, we have a portfolio of stocks and it represents, 10% of the portfolio. He thinks about it, within the context of the whole business, basically.
Yeah, Berkshire owns both businesses, operating businesses and stocks, and it finances them basically with insurance. It also, has equity and stuff. But so it's kind of three parts to it. There's the businesses, there's the stocks, which also work just like businesses in terms of look-through earnings, and you're financing with the insurance. Those are the three sides on which you kind of take risk, and those are the three sides that you can kind of get returns from. Berkshire hopes to kind of be flat on the insurance side in terms of profit or loss from the actual underwriting, and that'll finance the other stuff at about 0%. But when people try to analyze the business or something, that's the right way to do it. Is those three things is what matters. And so imagine imagine he's running a bank and he has a securities side and a loan side, right? If loans are 20% of the balance sheet and there's 10% of the loans are in a single borrower, right? That's 2% of the balance sheet. So that's, if loans are 100%, then it's a different story. So in this case, they have a pretty good mix between the two things. I think that the person who they were talking about, who was not the one who asked the question, so it's very unfair to the professor on that one.
Yeah, he was probably watching it, and then his Twitter got blown up and stuff like, all these clippings and stuff like that.
Yeah. This other guy that I know says this. How about you respond to him? He criticizes you.
It's like asking for myself.
Yeah. So, but he would probably be worried even at the levels that Berkshire has in terms of concentration, even doing it the way that I just said. Even saying, okay, we'll take the business and that part. I mean, we could do that. I don't, let's see. They own 5.8% of Apple, right? Can you get Berkshire's book value, just balance sheet for me?
Total assets, $948 billion.
Okay, and what's Apple's market cap?
Apple... 2.7 trillion.
Okay, 2.7 trillion. So what is Berkshire's position in Apple is they're about let's see, you have it on
5.8%.
I would say that
right?
they're at, let's see, I was going to say, so about 150 billion. Yeah. So what is their position in it? It's sub 20% of the total company, of their total assets, of their total balance sheet. I don't know if it's 17%, if it's probably more than 15, less than 20. I don't have it, in front of me, but it would
116 billion.
116 billion. Okay. Yeah. So, divide 116 billion into 950 billion for a total balance sheet. Now that includes goodwill and stuff and whatever. But if you're asking, like, is Apple more like a 15% position for Berkshire, like compared to other people? Yeah. But the other thing that's complicated is, like, when we talk about people's portfolios, individual investors, right? And they're like, I have 20% in this stock or whatever. A lot of people have a house that's the same amount as their stock portfolio. So no, you have 10% in that. You have, when they actually do, and they're like, oh, and then I own these things that aren't actual stocks and what, it's a pretty small number. Like that's my that's my stock portfolio, but I also own these bonds, I own this ETF, I have this, like, so most people listening to this, look, the thing you're overexposed to is you own a house and you own it on leverage, and you're very, very exposed to that. The thing Berkshire's really exposed to is on insurance side stuff. Apple's not a super risky stock, like we said. Maybe it's 15% of the balance sheet. I don't know that Apple as 15% of the balance sheet is riskier than an index, S&P index in a 60-40 portfolio, 60% of your. Maybe you're taking the same risk. How much company specific risk is there really? So I don't know what he actually said because he wasn't the one asking the question and everything. But yeah, the way I would think of it is more like the way Munger thinks of it and stuff is like, okay, if Apple has risk that's different from the market and stuff, how much of that risk does it have? Then what size are we versus what size do people normally have in these things? Like I said, even a very highly diversified, say 60-40 portfolio or something, would have 4 times more exposure to like general market stuff than Apple is. Apple certainly has specific risks with mostly product risk. There's not a lot else. I guess it could have specific risk with some countries it's in and some government risk of regulation and stuff. Has no credit risk, absent like its product not doing well and stuff. So pretty low risk. Yeah. I think if Apple was double the size that it is, I don't think it would be the end of the world for Berkshire. The question is whether it's like too expensive and stuff, because it got to this size by going up a lot in price. And I think that's a reasonable concern to have, that you might have a lot in a stock that isn't very cheap. But if Berkshire could have twice as much invested in Apple, but at a lower price. And I'd say go for it.
Some golden nuggets from the meeting, little pearls of wisdom. You should write your obituary and try to figure out how to live up to it. That's something you get wiser on as you go along. That was from Buffett. Buffett also said, don't make any mistakes that take you out of the game or come close to taking you out of the game. You should never have a night when you're worried about investing.
That's good.
That was a good quote to holding cash as well, I believe. Talked about Tom Murphy and his, you could always tell someone to go to hell tomorrow quote, praise by name, criticize by category. He also mentioned that in 50 years of friendship and business, he never saw Murphy do anything unkind. Buffett said, you need to know, this was an interesting one for me. You need to know how people can manipulate other people. And then you need to resist the temptation to do it yourself. Basically, learn how to manipulate others, but don't do it. But learn it for your own benefit. Yeah.
Yes, that's very clear from some of the Buffett biography things, especially when he's talking about K. Graham and stuff.
I was literally going to bring up K. Graham. Yeah.
Yeah, and it's true. So, I think those are important. Buffett is very, very good at avoiding being manipulated by other people, at saying no to people, at just saying this person's a charlatan, I'm not going to engage with this person at all. And a lot of people aren't as good at that. And then some people who are good at that then, have the problem that they're willing to use those things in manipulating other people, which in the long run is always a bad idea. I mean, if you look into the history of people who commit frauds and do all these things and stuff, probably you find a lot of more recent friends. You don't find a lot of people who knew them from a long time ago and still think highly of them, right? So with Buffett, you'll have people who he's known for 60 years or whatever, and they say good things about him. Usually if you have, someone like the Theranos founder or whatever, your character witnesses are much more recent people that you found. They're not people from a long time ago, because eventually your manipulations of them and stuff will make them just not want to be involved in your life at all and stuff. So they'll have a time where they were enthralled by you, and then a time where that sort of illusion broke for them. And so usually, people who manipulate people that way have to keep finding new prey to do that. You really can't keep manipulating the same people all your life. So it's not a good long-term strategy. It's kind of like the honesty is the best policy that, but Munger has said and stuff, and pointing out that they didn't say honesty is like good and you should do it. Morally, they said it's the best policy, and it is the best policy in the very long term, although it's usually the worst policy if you're going to do it one time, right? If it would be best to have a perfectly honest reputation and then lie one time because you get away with it. But as soon as you do that, you have a bad reputation. And so, the right, even though it seems like you get further by manipulating people, you actually won't in the long run.
On the whole kindness thing, Buffett said, I've never known anyone who was basically kind who died without friends. He says, I've known plenty of people with money who have died without friends, including their family. So this whole idea of longevity again, staying in the game, being kind to others, the idea of deserved respect, just honesty is the right policy, playing the long game, right?
Yeah. And for some of those people, it might not have mattered and stuff. I don't know. I mean, it might have mattered a lot on that stuff. I don't know. I don't know if some of the Redstone cared if anyone liked him. But certainly Buffett and Munger cared. So it's, different things are important to different people that way.
Any other thoughts or anything, big takeaways from the meeting that come to mind?
Well, there were some old stories I thought were very interesting. I've been wanting to hear more about some of them, but they weren't the most interesting to other people. They told a little bit of a story about Ben Rosner at Associated Cotton Shops, and they'd been mentioned of that before. But that's a business that did really, really well when run by one manager, and then immediately fell apart. And is an example of a business that could be really successful. I mean, it wasn't just slightly successful; it had great returns on equity and stuff. Being that just this little retailer, not little in terms of locations, but each location was small, and it was not a super easy business. But it was way better than the department store that they bought, and did not have success at all when not run by that person. So we've talked about Made in America, right? And we've talked about my father's business. So those give you some ideas of one person and how important they can be to the development of some retailer. But it's a tough operations-driven business. And so just like insurance, the problem is that some of these things, like a good underwriter in insurance, but one that doesn't have distribution advantages, you lose the operator and the business falls apart. And that certainly seems to be what they were saying there. They're talking about how he had no education and all that stuff, but that he was just naturally someone who was very successful as operating in a retail business and a really good sense of money sense of how to make money, how to keep money, and very driven. And when you lose that, then you can't. It's so operations based the business that it doesn't last. And so it's something that looked good and posted good results and then had problems. And they had similar things, I think, with insurance things. I always think about those two as having a lot of similarities, insurance and retail that way, in that you can make a lot of money by just being a really good operator, not actually having any moat, as they would say. But as long as you can keep that person in there doing it, minding the store there, you can get those results, and investors looking at it will think, I'm sure if Associated Cotton Shops was public, they would have seen, they would come up with some story about how it must have a moat and great things and whatever. And it's one person, and when they're gone, that's it. So you've got your things like Geico and stuff that do have a moat, but you have other things that are just really well run. And when you lose that person, they fall apart.
Did anything stand out to you at all about the meeting? Anything that Buffett and Munger said other than telling that story?
Yeah, I mean, I think they could have. I think they were willing to tell other stories from a long time ago. They seemed in a mood to talk about those kinds of things. More
the
so
energy
than
was great, wasn't it?
Mm-hmm. Yeah. So I think they were definitely in a good mood for nostalgia and all of that stuff. I think they're more eager to talk about that than like politics and stuff. One thing that Buffett did say actually quite a bit, and I will echo here, is he sort of expressed some concerns about inflation longer term without saying the word inflation a lot. But basically he said, I have nothing negative to say about the Federal Reserve and whatever, but at the end of the day, the Federal Reserve doesn't control how many liabilities are out there. I mean, it controls what form they're in and stuff, but it's what's the deficit over time. And I definitely got the feeling that, and this could relate to the energy things and some others, but people wonder why would he be as bullish on energy and stuff as he is. He may not mind having things that are a little more hedged in terms of protecting him against the risk that he's getting paid in just nominal dollars in investments. He's definitely said, look, Apple will just raise if they, he hasn't said they'll do this, but this is what he means when he says about the pricing power is, like the Apple will raise its prices basically if it has to, and the business will still work out because people like it that much that it'll extract the value. So I think he may be worried about government policy on that stuff, and that I think is definitely something that came through in what he said.
I was gonna say that's when Munger talked about if someone jumps out of a building, eventually you hit the ground. You're gonna hit the ground or whatever.
Yes. But Buffett said, but Buffett said basically, but the thing is, we could stop. Like we're kind of like we're going to probably choose to hit the ground, but we could stop. It's not a foregone conclusion. It just requires some moral courage that way. And I think that he's more concerned about that than say what exactly is the right rate for the Federal Reserve to be at and what's going to happen in the near term that way and all of that. He did also talk about how the business has dropped off a huge degree completely from COVID and stuff, that stuff's over, and that you've seen a real slowdown in terms of the froth and everything of that. So he made a big point of that. That wasn't really prompted by anyone. That was just him explaining the quarterly results and everything.
Has the meeting influenced, like going to these meetings, right? So we went this year and last year. Has going to the meetings changed the way that you think about anything with Berkshire, or has it influenced your understanding more deeply in any way?
I mean, no, not really. No, I'd say. I mean, I think the thing that it does a little bit. It impresses me the most is the degree to which Buffett has been able to be intellectually honest with himself, which no one else could do. So it's a cult, and they all come there to take his advice on everything and all this, and come up with reasons why, even if he reversed himself on Taiwan Semiconductor, it can't really be that he reversed himself on Taiwan Semiconductor, whatever, but he just is able to see, is able to behave in a way that's fairly similar in terms of at least his investments in public things and probably with acquiring entire businesses and stuff, behave in a way that would be the same whether or not people are watching. And most people can't do that. It's very dangerous to most people to get a lot of praise and to have a lot of people coming to you and saying, oh, what do you think about this and that? Because you will get bad at your job. And being able to apply more criticism to yourself and your decision-making, everything than they are. So I think that's really important. And he's done it a bunch. We talked about reversing himself on Taiwan Semiconductor, even though people would see that, and he knew that, it was public information. He reversed himself on Oracle and said, I sold it because I realized that I didn't know, I didn't know anything about it. I didn't understand it, and I shouldn't have bought it in the first place. And he did that in like a quarter. He sold out of the bank stocks, really impressively that way. Sold out of the airlines really impressively that way. It would have, a lot of other people would have just held those airlines forever. And you could say, well, maybe it wouldn't be a problem that Berkshire owned them, right? Maybe they get bailouts. Maybe it would go up over time and it would have been fine to do all that. But lots of people would have sat on a lot of those things. Almost no one would have sold all the bank things the way he did. And we'll see if that's right or wrong. But it's a willingness to do that even when under public scrutiny, to reverse yourself on those things and to act quickly that others, don't have. He's extremely decisive in his investment decision making in a way that others are not. And he's maintained that not just in old age and stuff, but as being a celebrity. And anyone else would not be able to do that. So that's the part that's most impressive, is how impervious he is to the celebrity stuff really messing with how he invests. Coca-Cola, I think he would have sold if he hadn't said all those things about it for all those years. So, I mean, it's not 100% perfect, right? But he, because he couldn't think ahead of time that, all right, so some of these brands that I'm buying and putting in my annual meeting and stuff are going to go to 70 times earnings or some insane thing or whatever. But other than something like that where he almost said we're going to keep it forever, and maybe sometimes his assessments of people, right? That's something he has to be careful about, because I think it is dangerous if he publicly praises people, being able to reverse yourself on that later. Because he's very willing to praise people publicly. And in some cases that could be an issue of getting yourself out of that if those things change. But those are the only ones I can think of where he's really gotten stuck with the fact that he's so public that way. I think it's a big danger to make a lot of public statements, to write things, whatever, even for investors that aren't very well known. I think it really harms their performance and their decision making, and he has the worst case of it of anyone, and I think handles it much better than most.
Do you think he's able to do all that, or a huge reason he's able to do all of that is just the way he also sets up his life and maybe insulates himself from that criticism, right? He's not on, obviously, social media. He doesn't really even have a cell phone. It sounds like he doesn't go on podcasts once a week and talk, 2 hours about stuff that's going on in the market and the economy and stuff like that. I mean, for someone like him that doesn't take criticism, or doesn't like criticism, I guess they've written about in the Snowball before how he's kind of like that. Do you think he's able just to do all these different things just from the way that he set up his life? To me, it all sounds like very intentional, right? He moved back to Omaha. He didn't like being in New York City and everything that comes with that, perhaps like being around all of the noise in the financial industry and stuff like that. So do you think a lot of how he sets up his life has contributed positively to being able to do everything that you just spoke about?
Yeah, I think that's possible. Sure. I mean, I think the biggest thing, and none of that hurts, that helps, But I think the biggest thing is it's something innate because when we talk about something like the Taiwan Semiconductor, that's someone who's thinking in bets, thinking in terms of insurance and those kinds of ways of thinking. That is not necessarily predicting an outcome, but in reassessing the odds will make a decision that way. And that's the kind of thing, and the Snowball or American Capitalist or whatever, when they talk about, he's not willing to do a small bet for, if someone gets a hole in one, let's throw in money for it or whatever, because he must clearly think in terms of those odds and stuff and be a stickler for that he has this belief in rationalism that way. In fact, there was a question about if you'd ever let emotion in an investment decision. It was interesting the way that they answered that. They pretty much said that they don't make decisions that involve emotion.
Mm-hmm.
Now they said that they've left people in who had dementia and stuff, and so they've probably been too emotional in terms of how they handled CEOs. But they've avoided making emotional decisions that way, which is very interesting. It's not 100% true exactly. I mean, it depends on what you mean by emotion. If we're talking about certain sentiments that don't involve financial decision-making stuff, they've definitely let it be involved a few times. I mean, there's no logic to leaving Berkshire as a textile mill operating as long as it was, except for moral reasons. And there's probably an emotional component to why they're keeping the Bank of America one. He's basically said, he was basically saying it'd be dishonorable to sell the stock, right? I bought in as like a public showing of, I mean, he didn't say this, but this is what if you think about what does Buffett mean that I approached them, he's saying, look, I gave my stamp of approval and stuff to withdraw that after I approached them and they agreed to do this deal would be like not an honorable thing to do. And so that's why we're in that stock. So there might be other people who wouldn't do that. I mean, I think Carl Icahn would say, I can sell that stock, So I think there's some element of that actually that they don't, Munger or Buffett don't recognize as being emotional, even though it does have an impact on some of their investments. But if they mean greed and fear, then yeah, they're just not wired that way.
Anything else that stood out to you, Geoff, about the meeting?
The meeting itself, no.
Anything that they said about Berkshire, the operations, the portfolio?
No, I don't think that there was. I mean, I don't know how informative it is about Berkshire. The annual meeting, I would say there's not a lot in it that way. They put out a good 10K and everything. I mean, it doesn't go into deep disclosures, but you're better off reading the letter and the 10K than you are going to the meeting if you wanted to learn about Berkshire. Yeah.
He was talking about managing smaller sums of money.
Yeah.
And
I want to talk about that because he and Munger disagreed entirely, and it's the whole basis of our investment operation.
Yeah. Buffett basically said if he was managing smaller sums of money, we've all quoted the quote before, right? That supposedly he could earn 50% a year if he was investing $1 million or 10 million or just smaller sums, and how it gets much harder when you are scaling up with capital, everything that I think everyone listening knows that. But he even said, look, if he were starting over today, he would be focusing kind of on a different, pocket of the market, smaller companies, more obscure stuff, more off the beaten path. He probably wouldn't be buying Apple is, I think, what he was trying to communicate if he was managing smaller sums today. And he's very optimistic, it sounds like, about the future, and Munger isn't. Munger thinks it's going to be much more challenging going forward for value investors. Yeah. And how do you, I think somebody asked, like, how do you deal with that or whatever? And he basically said, you accept the fact that it's going to be harder. And that's pretty much it to be a value investor.
Yeah, this is an area in which Munger and Buffett have very different views, right? Munger's views are almost efficient market hypothesis like in terms of how bad it's gotten with just too many managers trying to do much the same things, and that they are eliminating the possibility for any of them to have, alpha or whatever you want to say. Buffett's view is we got too much money, and if we just could stop having all this money. I mean, they, in fact, said that very plainly when Munger said, well, every decade our returns have gotten worse and stuff. And Buffett said, it's the size of it that's the problem. It's not that we couldn't do in the 90s what we did in the 50s. It's that we were so big in the 90s versus the 50s, right? Like, that's what he's saying. It's just too much money. I wouldn't know what to do in the 50s if I had all this money. It's not that those were the golden age and this isn't a very good time for investing. So they just have a disagreement on that, where Munger sees it as there are all these inefficiencies and stuff that have been ruined by the proliferation of money managers and people charging, like we do, percentages of things and investing and stuff, and all trying to do much the same thing. That has caused there to be very few opportunities and things. And Buffett feels like it's just a size thing that Berkshire has, and that there's always things that you can do if you look hard enough for them. And as you said, you think I'm more like Munger than Buffett. And so that's probably in part because of things like this topic.
I would say you're a combination of both, but I would say your personality and stuff is probably much more like Munger than
Munger. Yeah.
Yeah, I would say so for sure.
Yeah. And I've talked about this. Yeah. Back in whenever he said that quote that he could earn 50% on under $1 million, let's say it was, I don't know when it was, but let's say it was the late 90s or something. If he said that, I'd say that too. I could have done 50% on less than $1 million. Not for long. You do it twice or something, and you're going to start running into, okay, now you're managing quite a bit more than $1 million, and then a little bit. But if you were showing no one what you were doing, you can invest in anything you want to. Yeah. I don't know if that's true today. It was a lot easier in the 90s even than it is today. Just in terms, and now we're having all this AI stuff and all of that, and what was that going to mean? It's going to be even worse in terms of the routine, unthinking sort of processing of information. What was an advantage years ago was Buffett flipping through the Moody's thing like we were flipping through the Japan Company Handbook. Finding the filings and reading them. Other people weren't reading the filings that I was reading, Now it pulls it for you, puts it in Quick FS, Guru Focus, Morningstar, puts it in screeners, whatever. And so things that don't require human thought are already kind of being done that way. I was talking to you about how there's an error we own something in which there's a mistake in the thing, and I noticed that everyone's pulling the data from the same place. It's a share count error, which is a pretty bad error, but
makes a big difference.
Basically, yeah, and it just thinks that there are more shares out and that there used to be less shares, and then like a lot never happened. So, but because this error was put into Capital IQ or whatever things that everyone else is pulling from, in this case, it's then been worked into every formula of things, so it's incorrectly calculating earnings growth and this and that, and everyone's basing off of it because it's such a simple thing. And it was actually driving me crazy because I knew it was an error, but I was trying to find where it made the error, So I was reading, like, going in detail through past annual reports to find why did it think that there was a lot, like, okay, it misinterpreted a stock split or what happened. But I knew it was an error right away because I'd read the reports and stuff. So that is, maybe something like that will happen. Hopefully that will happen. And people's perceptions of the past will be all messed up because it's incorrectly calculating things. But absent that, you just have a very different situation now than you did before. There are people that will buy anything on a quantitative basis, don't need to know anything about the stock or anything. No matter how small it is, no matter whatever, if it looks good on Quick FS or something. And so that stuff is the things that are hard compared to the past. It used to be easier to find that. I don't know if we'll have a future where, when we talked about, J&J Snack Foods and Village Supermarket, and because a computer can know that you should buy those things. And that it would need to have a very strong human override of that, of saying that there's some really good reason, which there wasn't in any of those cases, why you should not do that. Because, it's not going to just go, oh, I don't really it's too much trouble to look at this. It's small, it's whatever. A computer will just look at all 11,000 options and stuff and present it to you. And whether it's a thinking computer thing with AI stuff or it's just a screen that people pull, it's a real problem. And so, and it relates to like why I try not to talk about things that we look at and stuff, because the truth is that some things, especially very good ideas, are incredibly simple. And if you just say the name of the stock and why, here's a stock, we're buying a lot of it, whatever, people can look at it and in 5 minutes understand that it's attractive. Something that takes me 20 minutes to explain might be a good stock, and maybe I can't convince people to buy it and whatever, but honestly, it's probably less attractive than the thing that's really simple to understand. So, and Munger and Buffett understand that because they understand the kinds of things they invested in back then and how strange some of the anomalies were. So,
do you think that means that there will be alpha to be had in, like, let's say countries like Japan, where maybe perhaps most market participants don't focus there, or other countries, or just more complicated situations in the United States? Like, do you think that the United States is going to be the only market that gets even more crazy competitive, or would you expect that globally as well?
To a certain extent, globally. It depends. Like, we have tried several times to get things that we didn't get because of just complications for us and whatever. And I mean, you've experienced it now that we've had the fund for a while. How have some of those things done? Pretty good. Like we said, okay, we're not going to take it because it complicates our tax situation. Well, the answer is anytime that's why you don't buy something, you should buy it.
You should buy it.
If it's I have to do much more complicated tax things for the partners and stuff. If it's this is going to have complications and be held up for a while and whatever. I mean, every time that's been the answer. The answer is you should load up on it. That we understand that people aren't doing this because it's complicated, it's messy, whatever. Japan's interesting. Like it does have a little bit of that because historically the Japanese investing public, and this is true in a bunch of other Asian countries too, but we'll stick with Japan because it's kind of cheap, does not have the same historical background in terms of the intellectual tradition of like value investing and things like that as the United States. It's just not very present there. So the advantage to that is if you go places where American investors don't go as much, value investing is a strategy you can kind of apply there. I mean, this is getting very esoteric, right? But anytime we apply any kind of strategy, it's not going to work at all times or whatever. Like imagine you're playing poker or whatever, right? It's going to matter what the strategies of the other people there are too. So some strategies are better than other strategies on average. Though if everyone adopts, if you happen to be unlucky enough that everyone adopts a strategy that doesn't work so well for you, everyone else at the table, then even the sort of optimal idea of what you're going to come there with could be bad, right? And so if every single person in Japan was an obsessive value investor, it would be really hard for us to come over there and add anything with value investing. What works best is when you can bring a strategy that's different from what others are doing, and it works. And so going to other countries, right now works better than the United States that way. But also if everyone wants to buy the compounders, then you notice that other things are not so good that way and you apply that. You have to be flexible in terms of what works and what doesn't by just assessing the odds and what's going on that way. So I don't think that there's no reason, like academics study this stuff, right? And, they'll think, oh, there's a price to book anomaly, or there's a whatever EV to EBITDA thing, or if that's your thing that you're going to invest for the next 100 years, I think that's dumb. That's not a good idea because it could work. It totally could work and never go away. But there's no, there's no way you can prove that other people wouldn't just adopt that approach. But there are going to be some approaches that work. There's always going to be strategies that you can have that can take advantage of what others are doing. And that's why, like, in the late 90s, early 2000s, I had a lot of success investing because I think it surprises people that they're like, oh, well, you must have, like, lagged the market when it was going up and you're doing value investing. No, not really. Then it comes down. It must have some effect on you that the market's crashing. No, not really. But it's because of the way that it was all working at that time, money was being sucked out of these reasonable things and into that unreasonable stuff. And so, it's almost like you had the opposite strategy of this .com nonsense of buying into things with no revenue and whatever and paying really high prices. You just bought the very real things. But in the mid 2000s, that stopped working because everyone got over the .com, delusion and started to think it's good to own real businesses that have real assets and real earnings and whatever. And it'll keep changing all the time, what people overvalue and what they don't, So it can get harder in some ways. You're always going to have to buy the unpopular stuff that's good, right? You have to be different from the crowd, so it has to be unpopular, whatever you're buying. And then you also have to be right. So unpopular but correct decision is what you have to make. And it used to be easier to do that just mathematically. There's a bunch of things that I did that were very simple, and I don't see them anymore. So someone has taken advantage of them or whatever. But there could be other anomalies I don't see. But I mean, there's a few things I did that it was almost impossible to lose money. Like especially things in the same arbitrage things that we've talked about, cash offers for things that you buy a bunch of stuff you get cash for and you repeat it over and over again.
Can you tell that story?
Just things in the same. About like...
I just think it's a good example of like how there wasn't a lot. Yes. Yeah.
Okay. So odd lot. With Sarbanes-Oxley, a lot of companies decided around 2005 or something. I don't remember. Wait, 2005 would have been like the last... yeah, so the last 10K thing from a lot of them was around then. I mean, but after Enron, but before the financial crisis, let's put it there. That's really the time period where all of this happened. So you're somewhere before the financial crisis, but you're sometime after Enron and WorldCom and all the scandals, right? So during that time, you have a move to clean up corporate governance in the United States, meaning like to stop with all of this, all of the stuff that happened during .com that we're just talking about. That was bad. Okay. So some of these requirements would be costly. Not so much for large companies, but for small ones, right? So that you might have to pay people to be on your board that actually, would be like having salaries for things was what you were possibly going to face. That you're going to have to pay for things that are more substantial, sort of audit of whether it's internal controls or whatever things, we're talking about things that could be, it might not sound like a lot, but $500,000, right? It could be $500,000 a year. If a company's making a few $1 million and it has large shareholders or whatever, it's going to say, well, I don't want to do that. Like its peers and stuff are like private, they know private companies and things, and they think of this company like that. And, they don't think they're Apple or whatever. So anyway, because of that, these companies decide we want to go private. The problem is under SEC rules, they needed to get under, at that time it would be 300 shareholders of record. And so that would exclude things held in street name and stuff. And to do that, they basically need to get rid of their very small shareholders. So the easiest way to do that is just do a reverse split where you just say like 100-to-1 reverse split works well. So anyone who owns 99 shares or less gets cashed out, right? Because they won't end up with one fractional share. Okay. So because of this, lots of companies did this. And on each deal, you would just make money, basically. I mean, you would buy this stock, and then you would get paid your 99 shares, right? And beyond that, too, there was nothing wrong with them. I mean, you're taking no risk here because these are, I mean, if anything, the companies are probably better on average, the ones that were doing this, than anything else. I mean, it showed some responsible corporate governance things and all that responding to this and stuff. So there's no reason to think that you were taking on some weird risk you didn't expect by doing this, as is often the case. Like most arbitrage things that you do, you're like, okay, but what if credit conditions tighten? What if whatever? This was none of that. And so you could keep doing them. It was like, there's some books, what was it? The one, the Ed Thorpe book, right? Man for All Markets, was it? Yeah. He talks about mutual conversions at one part where, going or saying, put money in banks that are going to convert and then with those deposits, it gives you a chance to sign on to these things, to be part of it, and you can make money by doing that, because he had a nose for that kind of thing. And that's all that I'm talking about with the odd lot stuff. It was very, very small, right? So if you can imagine, right, 99 shares, let's say these stocks are pretty cheap a lot of the time. So let's say it's $8 or something, right? So you're only going to make whatever that spread is on that, but you're tying up $700 some for a period that's pretty short for a nice return in it, right? And there's no rule that you can't have all your money that you were going to have in good ideas and keep that in those things, and only do this with the stuff that you have on the side and whatever, and it only ties up for a little while, and so there are things that are obvious that way. Like I also mentioned that I was managing money for some people, friends, and I said to them, I have this situation. I'd been doing it for a few years for them. I have this situation that's going to have a high annualized return. Normally I don't know if that's going to happen or not or whatever. So, and their response was, oh, well, let's take all the money that we have everywhere else, put it in, you do this situation, and then we can take that money back afterwards and stuff, right? And so we did that, and they made lots of money on a one-time thing. I mean, the annualized return, I said it'll be 50% or better or something. It happened faster, so it was 100% or better. But what's important about that story is, unlike what anyone else would do, they, because they knew nothing about investing and stuff, were like, oh, of course you take all your money, put it into this good situation, then take it out and stuff, instead of oh, what's the portfolio going to be, what's whatever, you don't put money in when you don't have a great situation that way. And so there's a situation where we knew we wouldn't lose money really, and there was good upside for making a lot of money. And I happened to know that I was going to be able to get stock for them and stuff, which is not always the case. So because of that, they were able to put it to work, then make the money, and then you take the money out, because now we don't have anything like that, right? That we don't have a good opportunity. So it goes back to what it was before. So that's when Buffett's saying you make 50% a year. He's talking about things like that, right? That's what he did the chocolate one, the cocoa beans, right? Where Graham because he worked at Graham Newman, he was involved in an arbitrage thing, which is pretty similar to what kind of thing I was just talking about. It involves a little more thing because you have to hedge out the risk, right? But it's just manually doing basically the same thing I was saying with getting the 99 shares and exchanging them for the cash. In this case, getting the beans and exchanging them for the cash, same thing. So in that case, Buffett didn't do the arbitrage that they did. He saw how big an opportunity it was, and he stuck with it. And, that's what I mean with these things that used to exist, and perhaps they still do in certain pockets and stuff. But, and we do come across things, but obviously because I'm now doing a fund and stuff, we have more stuff where we say, oh, that's an issue because of size of what we do, because of compliance things of what we do, because of complications for, And, I mean, so you could, I guess economic theory and stuff would say, well, there's not really alpha there, right, that you're getting. It's just that the people are willing to take 15% a year lower returns if they don't have to do tax things. So it's just that the level of pain is so high for them for those things, which might be the case. Because like I said, I know lots of people who were interested in Japanese things and said, oh, my brokerage doesn't let me buy them in Japan. Japan's a pretty easy country to invest in compared to some countries out there. And, the answer is you got to open a brokerage account. You got to switch to a different broker or something. The Ed Thorpe thing. I mean, you got to go around the country in person sometimes
open up
those bank accounts. Yeah, because they wouldn't. Not all those banks would open them. I mean, banks don't have to take your money, and there's plenty of them that if they're a California bank or something, they're not going to take money from someone from Delaware. I mean, that's not a very good deposit of what they do. So, so you go around and do that, and that's what Buffett was like in the 50s and stuff, and I think that's what he means by the 50% thing. But Munger is much more negative on that there's been a change, whereas Buffett says it's size issue, right, that you have too much money to invest, and Munger says it's all of these people all thinking that they can try to make money, that there's one pie and they're all trying to eat it.
Mm-hmm. Mm-hmm.
What do you think?
That was about being a lawyer, the pie eating contest.
Oh, well, that was a different situation. Yeah. But I mean, there's only so, in other words, the profit pool is only what it is, right? I mean, so basically, when you're in investing and stuff, if you're going to outperform other people, then it has to come from someone else. It has to come from the mistakes of the other people who are in there that way. If you have a market that's 20% amateurs and 80% professionals, and let's say the professionals are very successful, the amateurs are very unsuccessful, the everything that they're going to make in profit, really beyond the just holding the investments, though, that 80% of professionals has to be taken from the 20% of the amateurs. That's the only way that it can work. And so as you increase the number that they have there, they're more people feeding on a smaller pool of profit, the same pool of profits, which means less per person. And I think that is definitely a realistic way to look at it. But, markets do sometimes go crazy. We talked to someone who in Omaha who was saying, even big stocks, this doesn't just happen in, your overlooked part of the world. Even sometimes I find big stocks that are mispriced and stuff and don't really understand why exactly they are or whatever. So I think there's some truth to both of what they're saying. And I've always kind of agreed partially with Buffett, because when people ask why to only do overlooked stocks, my point is not that there isn't things to do in other stocks, but I wanted to come up with something we could do all the time. Because Buffett's running a holding company. To some extent, people putting money with us, they expect us to do something. Don't just sit there, right? And Buffett, like in the 80s, right, he sold everything but like 3 stocks, and then he just sat there for a little while. And when I'm talking about me investing personally, there's like the best year I had, I just sat there, didn't do anything. I bought things the year before, and then you just hold them. But I'm not saying that all clients and partners and stuff are going to say, you've got to do something and whatever, but they're going to wonder what's up with that. I mean, they're paying you a lot of money to sit around and literally make no decision for a year. That does strike them as a little weird. So I think the idea with overlooked stocks, right, is that there's something to do there more often. The concern with the kind of area that Buffett's investing in, right, the really big stocks, is there was something to do in Apple when he bought it. So that was something, but he needs a Apple-sized idea, and it's rare that they get so mispriced or whatever. Now, maybe he could have bought up a lot of Meta if he loved that business or whatever, because there was temporary focus on strange things happening at that company, right? But in general, it's hard. So you get these moments, like I've been investing for about 24 years, and I'd say there's been 6 good years in those 24 years for value investing. Like that, where you're talking about, whether you want to call them naive strategies or whatever, not applying much other than just the ideas of value investing. There'd be 6 years where you just had an abundance of, you could do any of the stuff that we're talking about. They're just mispricings, and you could just buy the kind of way academics like with the quantitative stuff. And it was going to work great. The other 3/4 of the time, I don't think things have been that cheap enough to make that strategy work all that well. Maybe you do a little bit better than some things if you apply some things well, but it's more like what Munger says. So, but I've only been investing for, like I said, less than 25 years. And it's certainly true that in previous quarter centuries, it's been a lot more than 75% of the time that there was plenty of Ben Graham type ideas and things to do. So are you more on Buffett's side or Munger's side on this one?
No, I'm more on Buffett's side. I mean, and I think a lot of that is the where we focus. If maybe I would feel differently if we were investing in large cap stocks and stuff like that. But I mean, people always ask, how do you find interesting ideas and stuff? Like if you're going to focus on overlooked stocks or stuff that are over the counter or whatever. And yes, we do run screens, but I mean, how many ideas do we come across just kind of brute force, just going A to Z, right? Buffett talks about being a page turner. Maybe we're page clickers. Maybe you're a page turner with your Japanese handbook, but going through the A to Z list that you could pull from over the counter markets and stuff, I still find very interesting ideas that are clearly cheaper than if they were to sell on a on a private market basis, Now, there's other complications with that. Is it family controlled? Is there major shareholders? Is there stuff like that? But I haven't lost my faith in it at all. I mean, how many, and this is something that you and I have talked about off podcast, where we've come across different ideas. We've done the research. We've visited. We were very comfortable with it. And perhaps maybe it just didn't meet the hurdle required, either from a return perspective or confidence perspective of feeling comfortable with it. That's required if you're looking to make, 5 bets in a portfolio. And we didn't invest for one reason. And then, you see it get acquired for 200 or 300% above, the market price or whatever. And psychologically, that's hard to deal with, because you're like, yeah, we visited the place, we saw it, we understood it, we just passed because maybe the hurdle was different or whatever, or you had other ideas that you liked more. So no, I'm much more in Buffett's camp. I do believe wholeheartedly that size does affect it. I think actually there are obviously large cap stocks that get very cheap, but you don't see, when you talk about J&J Snack Foods or Activision or FICO, I mean, what were the multiples you paid for that? Less than 10, less than 15, certainly. You just don't see that happen ever anymore, it seems like.
You're talking 10 times or less
tougher.
And no debt. Yeah. And
you don't see that in large caps
for endless years. Not usually, right? Except like what we said, like if there's suddenly some weird obsession about meta. Yeah, exactly. Yeah. And maybe we've seen an airline or
movie
a bank
theaters
sometimes when people are worried about that. Yeah, exactly. And by the way, movie theaters, no major investor that I know of even owns them. Because think about it, put aside AMC, which is a meme stock, like the biggest one, the market cap's a few billion.
Yeah.
Like they can be 15% or something of the overall market for, maybe 10, 15%, whatever, of the overall box office. And that's small compared to what these people need to be in. They actually can't even be in some industries. If we excluded 50 banks, probably if you went on like Dataroma or whatever and looked for, or Group Focus or, whatever, the famous investors, right? 50 banks would probably be most all the banks that they're in. You could basically find, I would say, the 50 biggest market cap banks. There's probably 500 listed. 500 traded ones, maybe 400 some listed, but probably 500 at least banks that are publicly traded in the United States. So 90% of them they can't buy, right? Or they don't buy, or they won't buy, or whatever, and they crowd into the other part of it. So there's absolutely a big part of it is that. But the other thing is, like with us, that I think becomes more and more obvious with what we do, is the importance of the punch card thing, because there are inefficiencies that happen, and you start to appreciate what Buffett has had to do over his career with that, because they don't continually recur, right? Like there'll be cycles where there's cheap stocks overall, cheap indexes or whatever, but if you have a chance to buy Geico when it's on the verge of going out of business, you get that chance once. Geico sold for a ridiculous price to Graham Newman, and Geico sold for a ridiculous price to the biggest part of what Buffett bought. He bought it again later. So that's kind of fascinating, right? Because Graham's investors, if they kept it and stuff, made a fortune on that. Buffett made a fortune on that. But like in between, it didn't sell at a ridiculous price. It did really well because it's a growth stock and you could have held it and whatever, but they pounced at particular times. And the problem is when you buy 2% of your portfolio into a highly inefficient situation instead of 20%. There's no point of the round lots thing that I was saying if you had a portfolio that was $20 million, because you would put 1% in all the things you were doing together. So it would accomplish nothing. But if you were some 20-something-year-old at that time and you had just saved a little bit of money and stuff, I mean, that's a great way to juice your returns in the early years and then compound from there on that. It makes a huge difference that if your early years you made 50% a year or something, right? I mean, that helps the compounding in later years. It doesn't matter the order in which you get your compound returns. They're just as valuable early on as later that way. So it's the size of the opportunities. And so Buffett's always had this weird thing where even though he's a giant company now running Berkshire, he's always had to get really good returns, he's always had to absorb an abnormal amount of the stock for someone in his position. He's always done that. He's still doing it now with Apple. Apple's like the most popular stock out there, and what active investor owns almost 6% of the company? They won't even think about it.
Yeah.
And he still has to do it with even the most giant company out there. But when he was in little stocks, he had to buy lots of them. When he's in big stocks, he has to buy lots of them, which gives you an idea that maybe there's inefficiencies in really big stocks too. But if they're 500 S&P companies, there's probably not many of them at one time that are really that are mispriced at the same time. And so that's probably why we're misunderstanding like Occidental. It's not that he wants to take it over. It's just that Occidental isn't enough to satisfy him in terms of how much capital he wants to put in oil. It's just too much relative to what the opportunity that he's seeing, you know? And we all think in terms of like, oh, well, that must mean he wants to take it over if you buy a big chunk of a company. But sometimes you just, you know, he doesn't see a lot of other things to do. So, you know, it's a focus thing.
Yeah. And you don't see, I mean, I don't come across, you know, Sanborn map type situations. I mean, where it's like, oh, I'm making numbers up. The stock price is 10 and it's got $50 or $40 in a stock portfolio on the balance sheet in cash or whatever, or that could be converted to cash. You don't see those, but I mean, we've seen situations in smaller companies where it's like, oh, it's a market cap of, let's say 15 million and they have a stock and bond portfolio of 12 or 13 million or close to it. So you still actually come across those situations.
10 years ago, I did two that are that situation. One giant one small one. So it does happen that stocks trade below their investments per share and stuff.
But I'm saying it doesn't happen as much as Buffett 1.0 is what I'm saying. But I'm trying to say it still does happen. You don't get that in large caps, but in the pink sheets and being a page turner, all this stuff that, quite frankly, doesn't come up on screens, or if you type in a ticker on QuickFS, you'll see like the last fiscal years will be like 2014, 2015, 2016. I mean, the data is just completely not updated or not correct. That's good because that's like, oh wow, now I actually have to, you know, there's a chance for price discovery here because this isn't coming up for quants and you know, on screens and stuff like that, or at least as much as these other companies are. So there's still situations out there like that. I think the brute force method is the best way to find them. And so I'm much more in the Buffett camp. Now for large caps, I don't know. I mean, I think it'd be much harder. I mean, it's interesting, and we've talked about this, right? Like correlation, how much of what you are doing is basically the market and stuff. Your long-term returns that we took when we launched the fund, if memory serves right, it was like 25% correlated to the S&P. It was like 0.26, 0.27, something like that. Since launching the fund,
the private, exactly. Results from which is not the fund, but with what I did myself before then was that kind of correlation.
And since launching the fund, it's like 0.6, right? And we've talked privately about this. We're like, well, I mean, we did go through COVID where basically everything was correlated, everything went down and stuff like that. So it's actually been a little bit more than double what it has always been. But the thing that I think is interesting is it's different than the market. Investors are paying us, and I know they say there's no style points in investing, and that's true to an extent, right? But I just think you want to do something different than the market, than what investors could just buy the S&P 500 ETF and get themselves. And I think there are still ways to do that. I don't want this all to sound like a huge focus compounding pitch, right? I'm basically roundabout trying to say that I still think that those opportunities exist because we see them every single day, right? We're taking advantage of a situation that is pretty interesting. And there's still constraints, right? That funds have. We've talked about buying an LP, and we're like, well, this is going to be, we couldn't do it, right? And then there's other even size constraints, things that we can't do. So those ideas or those unique situations, they still happen in 2023. So
oh no, those unique things do still happen, and sometimes added regulations and added whatever things cause more of them. Actually, since we started the fund, it's become harder for people in interactive brokers to buy certain stocks. Yeah. I've seen the effect of that in the UK. We've talked about that. I mean, I would love to be, I'm not allowed, this is a self-imposed thing, but I'm not allowed to invest my own money outside of the fund. I just, the fund is the only thing where I'm picking securities for, and the managed accounts. But I have to invest alongside the way I'm managing money professionally, basically, right? So I don't own index funds, stocks, bonds. But there's stuff that I find that we don't buy that I would love to open up an account and buy it, because I know that, like the managed accounts, right? If Interactive Brokers won't do it, I'm like, oh, that's why this looks like this.
Yeah.
Because probably Interactive Brokers is like an incredible amount of the American investors, individuals who would be spotting this kind of thing. And they're just saying, okay, fine, Interactive Brokers, you're my broker. So if you won't do this, I'll just move on and find something else. But it's something that's a lot more attractive, right? And it's very small when you have those things, right? Because you don't want to have that problem with other stuff. But it is interesting that that wasn't a problem before. It's because of added rules and stuff and added care that they're taking on that. And dark stocks in the U.S., you've had the same thing where it's split. You had dark stocks either go and start reporting things, and then there's an active market for them, or you've had this expert market thing. And for some of the people listening to this, the expert market thing means they're like, the stock doesn't exist. It's just vanished, you know? There's still a market for it. I mean, that people who are running funds and stuff can see this, but that the average individual now, that stock is no longer an option to invest in. And it was the same company that it was before, but that was added regulation that caused that issue. And when we were talking, about, what we were trying to do before that, we were talking about, that's added regulation too. I mean, we're not talking about we're not saying what that situation was, but actually a decade ago, those securities we could have bought them, and we can't, because it's become easier to expedite certain things by complying with certain regulations that make a less active market for some things. And so that is an issue in some cases, or that it's happens in other countries, right? So there's things where we'd have to go over and buy things in another country or something, because the reason why they're not in the United States is the higher regulation here than in other places. So it can happen, just like all that stuff was just caused by the Sarbanes-Oxley stuff I was saying, that caused that weird little thing where you could go around buying 99 shares, getting your cash and moving on from one deal to the next. Sometimes those same things could happen now with dark things or added regulations of things or whatever. Who knows if like Chinese stocks weren't able to be listed in the United States, would the price for them be different just because of that, even though they're the exact same company or whatever? So I mean, it can still happen. And also, to be fair, Buffett and Munger don't really look in other countries, right? So like if they were young, probably Buffett would have to now, starting over, I would imagine, think more seriously about the worldwide stuff. With computers and all that he would have access to the internet, he could apply more of that kind of idea to other countries. And, back in the 50s, you couldn't do that for the most part. And you would have no way of getting information on these things, and many markets weren't open in any way, even to professionals, to do that. So you could maybe apply some of the ideas that he used back then that have become kind of harder to find any of those inefficiencies in the U.S. in other countries. And we know some people who do that, who probably focus on countries that they wouldn't focus on, I bet, if they were investing in the 50s, because it'd be easier to invest in the U.S. Instead they're kind of pushed over to trying to find that stuff in other countries. Mm-hmm. And Buffett and Munger don't know anything about, obviously, other countries and really small size anymore, because they've been managing so much for so long that they wouldn't, think about any small inefficiencies. They have to think only about these giant things, like the T-bill thing that they did. Yeah. So that's the only kind of things they can really take advantage of. It has to be something big.
Mm-hmm. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. You can expect to also listen to us next week. Took a little month detour, but here we are and back to producing content. Be sure to check out all of our content on the internet. Go to focuscompounding.com to get access to investment write-ups from Geoff and to learn more about our money management services. But truly the best place to get everything that we put out into the investing universe is to follow me on Twitter, which is @FocusedCompound. I thank everybody so much for all the support. Leave us a rating and review, and we'll see you in the next podcast. Take care.